Hey everybody, Boris. Welcome to the weekly technicals for August 22nd through 26th for the majors. It's been a very, very trying week, I think, if you're trying to look for any kind of directionality. It's certainly been a week full of fake outs and changes, dollar up, dollar down. Ultimately, in some ways, the dollar is really weakened, based really on a lot of Fed fake out information. Basically, the Fed authorities started the whole week with very, very bullish rhetoric, and really from last week they had very, very bullish rhetoric, and then only to kind of fake the market out by showing in the FOMC minutes that they had zero intention of really tightening anything in the near-term future. We do have this week the Jackson Hole Summit of all the central bankers, and it's probably going to be the major driver. It's not till the end of the week, so I don't think it's going to affect trading early in the week, but that's going to be the major bated breath moment for for this week in terms of whether the central bankers are going to do anything, whether it's Janet Yellen, she's doing a speech, is going to kind of change the posture on the Fed, since she's the most important voice on the Fed. A lot of the other Fed governors clearly starting to signal that tightening policy is very much due. But there's a couple of problems here that I've pointed out beforehand. Number one, the political problem. You have you cannot possibly imagine the idea of hiking rates in September in the midst of a very, very contested electoral election here right now. That is probably one of the most partisan elections we've had in this century, or over this century. So I think the Fed is going to stay pat in September, which means the only possibility is that in September they'll communicate very clearly that they're going to hike rates in December. That might be mildly bullish, and it might stabilize some of the dollar fallout. But really, for now, it's just a lot of back and forth flow. It's typical dog days of summer, low liquidity, very, very directionless trading in many ways. But I will say that the charts, no matter how hard you want to try to make the case for a pro-dollar move, are really signaling that the dollar is losing a lot of steam. Now, can this be reversed this week? And can the charts fake us out again? Absolutely. So you have to really always keep in mind the fact that the charts could seriously fake you out again because of summertime flows. But generally, when you're looking at the charts, we're going to take a look at them in just a second. They are starting to form very anti-dollar structures across most of the majors, and that's very much worth watching, despite the fact that the fundamentals may be trying to point the other way around. So looking at the support resistance levels in euro and yen and in pound, euro now resistance comes in at 1400. We're now coming up to some very, very key resistance points, and it's going to be very much worth watching this week, because I think that's probably going to be the much more serious resistance point for the euro than was the prior resistance points. Support now comes down to 1200. Dollar yen still sort of struggling in this 100 to it's not even, you can't even really honestly say 103, but we're being generous here at 103 resistance. So far it hasn't even been able to clear 101. The reason I'm sort of calling support at 100, even though we've tested 99 several times, is because, and I guess it's probably, I really should sort of change this to a more accurate 99. Is because this whole 199 has been a very, very key important level for both the BOJ officials and the market. Now, if 99 goes, I think you could have a very, very quick move all the way down to 98. So therefore, I'd be very, very cautious of this thing breaking down, because the market has been testing it for 2 or 3 times, and so far it's held off of a lot of not so subtle rhetoric from the BOJ. I do think if they break it down to 99 or 98, the Japanese officials are going to be very, very upset, and we're going to probably start to coming into the market. Whether they're going to do verbal intervention or even actually direct intervention, it's going to be called for. Some analysts are saying that's not going to happen until 95, and they may very well have to wait till 95 to really come in with full force intervention. But clearly, this is very bad news for Japan. Data last week was horrible because the yen continues to just depress exports and created lots of deflationary pressures for them. And I think they need, at this point, I don't know what they can do except just absolutely go crazy and say, we're going to print $1 trillion worth of yen in 1 month and just completely destroy the currency in order to just begin to weaken it, because it's really, really having a very, very negative impact on the actual economy of Japan as we speak. Pound dollar had a little bit of wobbles. Now, pound dollar, we talked about the idea that it dropped below 30, then came back up on anti-dollar flows above the 130 level. And we thought all was quiet on the Western Front. I really thought that hey, they're going to one way or the other try to sweep the Brexit issue under the rug, and they haven't. Last Friday comes out Theresa May saying, "Oh, we're looking at somewhere like mid 2017. We're going to start thinking about Article 50." Remember, the moment that British politicians actually utter the words Article 50, and more importantly, the moments that they actually decide to pull the trigger on Article 50, you could forget cable going anywhere but down. It may take a while. It may take a few months for the market to begin to realize the calamity that would incur, but it will incur a massive calamity. Right now, cable has been bouncing back on essentially the assumption that Brexit is going to be swept under the rug. If that comes back up as a primary policy driver of UK authorities, I think it's going to have a much more deleterious effect on UK economy than anybody can possibly imagine. So, do we have a lot of data set next week? Not really. Let's just I'm going to just glance at the data here to see where the key points of pressure are for us. Sorry, let me just pull this up here. As far as U.S. goes, we have flash PMI, of course, for Europe, which comes out on Tuesday. That's going to be a decent read into the European activity. But remember, Euro really couldn't care less about data at this point. But we're really trading because of zero interest rates, really trading essentially on pro-dollar, anti-dollar flows at this point. We do have IFO, again, not of great interest. On the U.S. side, just durables. Second estimate of GDP on UK, really just absolutely nothing. It's the absolute dead dog days of summer. It's the end of August. As many people as possible are away. There's very little data set on the books. It's really going to be just sort of sentiment flows, pro-dollar, anti-dollar, and key levels that I think we're going to be looking for next week as as a way for us to try to trade some of this price action. Let's take a look at the charts here. So here's Euro. So what I was talking about, this is perhaps the most interesting thing about all the developments over the last few weeks, is technically, and this is the key thing, the euro, once we took out the 1250, really turned itself into a much more positive technical structure. Remember we talked about how like underneath 1250 was sort of a series of lower highs. It was bearing down, and as a matter of fact, at this point right over here, really thought that we're going to go right back and test the 1050s. Well, it didn't. It came down, came back up, and then the whole point being is that once we took out the 1250s, it was a completely different ballgame, because now the whole technical structure changes from being uber bearish to sort of mildly bullish, because you have a series of higher lows, right, being buoyed by an uptrend move. So now comes the really big moment of truth, which is this quadruple top at 1450, sort of 1350 to 1450, this whole zone of chunkiness. And it's going to be fascinating to see, because I think if we blast through here, that's a completely different picture than I think anybody in the market expects. A blast through the 1450 really turns the euro into buy the dip territory for quite a while, because it means that the whole structure of the euro has turned much more positive than anybody imagines. This, by the way, ironically enough, again, a frigging nightmare for policymakers in the European theater, because of course they're depending on a relatively weak euro to keep the exports going. It seems that everything policymakers are doing now, the market is doing the exact opposite. It's like the George Costanza of policy markets at this point, where what they want is exactly the opposite of what they get. But for us, as far as being able to just simply read price action, you do have to give the benefit of the doubt to the upside now. Now, yes, we're still holding against this very, very key resist level, and that's very important to watch this 1350. How 1350 trades this week will give us a lot of clue as to just how much negative sentiment there is against the dollar. If we come up and close above the 1350, then really 1450 becomes very much in view. That becomes the much more serious resist point, and that's where I would be watching to lay out more conclusive shorts against that, just sort of on a trade. But if we take out the 1350, at that point, euro becomes a buy to dip trade for quite a while. 1250 is the near-term support. That's really where it falls. If we start to fail and we kind of break below the 1250, then again the price action turns sort of mildly negative, and it's incredibly frustrating, I would imagine, if you're trading on any kind of a long-term basis, because it's fake out one way, fake out the other way, fake out one way, fake out the other way. But you have to be very open-minded and expect that the price action could go both ways, simply because we are in this very a middle of the road, no man's land type of time in the summertime, with very little true directionality, both fundamentally and technically. So I'd be watching this very carefully at this 1350. How we resolve here. If we can hold to the upside, it becomes a buy to dip. If we start to fade off this move and start taking it down to 1250, that becomes a sell the rally trade. And that's essentially kind of how the euro lines up. You got to let the price action tell you. Now, dollar yen, sort of a different story. Now, dollar yen has been just holding for its life around the 100 level. 99, as I said, 99.50 has been supported a couple of times. Very, very tough to see where we're going. But we break the 99s. This is the post-Brexit lows. The 99 break, super bearish for dollar yen. And suggested that the momentum could really take us down to 98, 97.50 very quickly. Remember, this has now become a momentum trade as much as anything else. And very, very volatile, by the way. Once we break to the downside, I'm very leery of chasing the downside move because the Japanese could come in very quickly and make a V-shaped bottom. Either way, what I prefer is sort of a lower risk profile is to buy the dips with a stop at 99. In other words, you kind of you hold on and pray that this is going to hold as a bottom, but with a limited amount of risk for yourself. So I prefer to trade to the upside. Oh, excuse me for just a second. Mainly because I'm very wary of intervention risk, which could really destroy any kind of a downside move. For now, the 101. Obviously, the near-term support, but ultimately the really big, the near-term resistance, and ultimately the really big resistance is the 103. That's really where a lot of the resistance is going to come in. And if we can kind of resolve ourselves towards 103, the chart in the yen will actually become much more pro-dollar than it looks right now. But it's at this point of pivot between bullishness and bearishness, and at this point it's a sort of kind of a 50-50 bet. But I think I'd rather take the bet to the long side with a stop here, just to see if it can survive the assault to the downside. And the pound dollar is, we tested the 130s, broke the 130s, then came back up on this anti-dollar move and sort of a better UK data. This is a couple of things that happened. We had better UK data, more anti-dollar flows. Market kind of calmed down, thinking that Brexit is not going to be a big problem. And then, of course, Friday, Theresa May kind of destroyed the whole idea that Brexit is not going to be a problem. She put it back on the table. Very hard to see. We're going to go 30, probably going to get tested to the downside at this point. The upside very much capped by 133. May see a double bottom test here. We'll have to see. It's a lot of everything here is very contingent on headline news rather than anything else of any import. I don't think we just have second revision of GDP, nothing else on realized sales. It's really, as I said, a very, very slow week as far as data set goes. So it's not even worth trying to figure out what the calendar is going to do. But here, this 130, most immediate support for cable. If we kind of hold it, come back up, that would actually be bullish because it would be a higher low. I would suggest that maybe we can go back up to 133, the market calming down and not taking the Brexit threat too seriously for now. So that's kind of how the week shapes up. I wish you guys a lot of luck. You need to be very nimble. You need to be very open-minded. And you need to, I think, in many ways, just kind of watch the price action before committing to it. Because, as I said, breaking the key levels up or down could give us a more nuanced view as to the directionality for the rest of the week.